Hi everyone. So today is our ninth lesson for investment analysis. So we have been covering many of the learning outcomes under OTHM investment analysis module, and I hope that you have got a certain amount of knowledge related to the learning outcomes or the indicative content which is in the module. So we had started a certain section on taxation. Last week, we spoke a little bit on taxation, and today we will be covering another main part of taxation, which is the income tax, and maybe little bit more towards uh, more towards income tax and what the different other types of taxation methods as well, so that you hopefully you will get a better understanding to understand the difference between the different type of taxation and how it is used, because that is one of the learnings that are expected from you, the knowledge of the taxation system. So moving forward today, I will be covering income tax, as I told you. So what is income tax? First we need to understand what is income tax. So income tax is basically like a part of taxation where a person or like an individual is kind of taxed based on the level of earning. So each country have a different type of taxation. Like, it depends on the country taxation and how it move forward with. And today we will be just trying to understand how a basic, what are the principles of income tax and how it works, and how this individual taxation happens and how it is computed and things of that sort. So, uh, uh, so, so why do we need to know about income tax? Because there is a method to calculate the income tax based on the country, and the country, and the taxation method that is being used by to calculate the earning level for the income tax purpose. So then there are certain areas where there are tax liabilities, and also there are like certain areas that you can reduce your certain payments which you can use to reduce the earning levels, so that the taxable income reduces as well. And there are so the knowledge of these areas will be helpful for any individual in order to calculate their own individual income tax. So so when we look at the principles of income tax is the tax levied on the earnings on an entity, whether it's an individual or it could be a corporation. So I just said individual because generally income tax is calculated almost for all individuals. So corporations also have their income tax based on how the company profits are. So uh, so one of the things that we need to understand, or what is very important here, is to identify the principle on which like income tax is paid depending on the taxpayer. So based on who, like, what, like, you need to understand who this income tax is being calculated, and what is the basis that is being used for assessment for this particular individual's income tax. So now we are looking at the basis of assessment. So basically, if you look at the individual, so whatever the assessable income tax which is earned between that particular tax year will be the taxation. Like, first we need to understand a taxation year would be from April to March. that is the general taxation year, or April tax ending would be generally April 5th each year. So within that period, whatever a person earns is like regarded for the income tax of that particular taxation year. So each person need to calculate it, and according to the level of income tax that is to be paid, the person needs to pay this to the as income tax. So in income tax, there are certain things that we need to understand. Sometimes things like personal allowance and like who is liable for income tax, and like the residence status, and those are things that needs to be considered when calculating the income tax. Just please give me one moment and I will be back. Just give me yes, please give me one moment. So what is personal allowance? This is basically the tax-free income threshold for any person, because a person is not kind of taxed for all the all the earnings. There is a tax-free allowance, and whatever if a person earns more than that tax-free income, then obviously that person is supposed to pay a certain amount of tax each year. And now, who are liable for income tax? So if there are two individuals who are partners in marriage, so they both of them will be considered as two distinct individuals. If it's even parents and kids, still it is each person is considered as a separate individual under the income tax law. So when it comes to residential status, the like to kind of identify the residential status is very important as well, because when it comes to income tax purpose, that will also be a certain there will be a distinct difference when it's for a resident and for a non-resident as well. So basically a resident is a person who has been in the UK with within a tax year, where the person is physically present for at least 183 days during the tax year, and for a person who is there for an average of 91 days or more in a year, in for at least four consecutive years. And so basically it depends, like however, like if there are circumstances such as sickness, or someone comes in to get some kind of operation or something like that, then this 91 year, but like they will be considering for 183 years. And when we look at ordinary residents, if if the person resides in UK, and then the person will obviously be considered as an ordinary resident and taxed accordingly. So domicile is a person who has a permanent home in UK, and so basically when it comes to taxation, a UK resident is liable to UK income tax on income earned worldwide, and opposed to a non-resident who is liable to income only on UK income. So if I just show you, I mean, it's not necessary to know everything, but I'm just trying to give you a small understanding, because instead of just talking about different types of taxation, that is actually what is needed for y'all at this level. However, what I feel is if you just go through a little bit, you will kind of have a better understanding of each type of tax. even though it's not, mandatory to go through all these in under your assignment, like the module guidelines. So as you can see, if you take a personal computation, a person will have to include the non-saving income, and then the saving income and the dividend income, and then there will be a total, and the earned income, which includes the employment as well as trading income, needs to be included. Then the property income, saving, like building society or the interest or bank interest, these will be savings from income as well. All this will be considered while computing. So here also, like the UK dividends will be added, all these will be added to take the total income. And there are few things which will be reduced from the income, which will be, one would be loss relief and interest payment, and where you get the net income after that, and then it could be personal allowance and taxable income as well. So these things I'm just explaining to you. It's not necessary for you to know any of these. It's just that the knowledge of the income tax, I mean, different types of taxation and those kind of things are also only necessary actually under your module. But I am just trying to give you a broad understanding, because just explaining, different types itself will sometimes, it is good, but because we have time, I thought it would be good if all of us kind of go through all this, try to understand the types of income and things like that. So many ways that a person may earn income. It could be income from employment, from profit, from the income that comes from ownership of property or savings, or even like income tax. So when it comes to earned income, it could be something coming from office, or like any types of employment, or like any type of profit from trade or vocation or profession, of kind of like a self-employment. All these will be part of earned income. Then we will move towards property income. Now, what is property income? This is basically could be something like a rental income, which comes in from any type of property that you own. So, but obviously, just like rental income, it could also be something like a premium that you get by granting like a short lease. All these things will be included under property income. And then there is dividend income. Now, what is dividend income? This is where the dividends, when you have invested on UK shares and you get like a dividend amount, this is what is considered as the dividend income. Now, moving on, we will be talking about savings income. What is saving income? Savings income will include things such as the bank or building society accounts. So it could be like the government securities, such as the treasury stocks and so on and so forth. And then also the company debentures or loan stocks, all of these savings that a person gets would be considered as saving income. Okay, so things such as bank and building society interest paid to individuals, and individuals by enlisting UK companies, debenture and loan stock, all these things will come under interest savings. Also, okay. So there are some things where the savings incomes are received without deducting the tax, such as like things, investment accounting, investment bonds, interest on government security, interest from court and company debenture and loan stock. So for them, what do? Is you just also consider them while you're doing the interest income as well. moving on. So now we will be talking about the tax exempt income. What are exempted? So exempted as in these particular income will not be considered as a income for taxation, right? So basically when it comes to income received from an individual savings account, like uh, because basically they will be in like when it comes to individual savings account or the ISA, we will not include it in the taxation because they will be taxed in a different way. And interest from national savings and investment certificates, such as the savings certificates which are issued by the National Savings and Investment NSNI, maybe fixed rate certificates, or it could even be index linked or have a fixed term, or like between 2 and 5 years, which is 25 years, like, and there is some kind of maturity profit that you get from it. So these are considered, which is considered as exempt. And then there is lottery, premium bonds, gaming winnings, and some social security benefits, which also will be considered as tax exempt. Okay. So the corporate tax base. Now different countries, I told you, so all this even individual taxation, what I told you was that, when it comes to the taxation, different countries have different taxable income. That is something that I told you. So basically this would result in large differences because taxable income, when it differs, obviously the tax base is different and how much tax each country gets will be different. That is obviously understandable because if the same taxation method is kind of used all over holistically, globally, then obviously the taxable income will obviously have some sort of similarity. However, because the taxable income is different in different countries, and the range and the benchmark of like where the taxation starts in, those things are different in each country, and the taxation amounts, like the percentage, will be different. And obviously people who fall under the taxable amount will be different, and amount of individuals in a country will differ. All these will help, obviously kind of change the taxable income amount, and also the the income that, hold on, it will also change the income that the organization gets from the taxation. So so basically taxable income or profit will basically change the accounting rules in use in each country based on how the country is defining their taxation. So taxation, corporate tax bases are basically, like, we need to understand, and that is has a schedular system of corporate taxation, and that there is like different classification of income and expenditure and even capital gains. So all these will be needed when it comes to corporate taxation. All these need to be included, and the taxable amount need to be computed just like the individual taxation as well. So now we will move on to trying to understand what is scheduler system of corporate taxation. So this is basically the entity basically kind of receives trading profit, capital gains, and patent royalties and all that, right? So all these earnings are treated the same way. It is little need to separate the income, right? So basically what happens is different schedules are used for based on the purpose and specific type of income, so that it is easy when it comes to computation of taxation, because the taxation for each type of income will be different. So when it comes to UK corporate tax schedule, there is a Schedule A, which could include the income of the land and property. There is a Schedule D, where there could be profit of trade or business or interest receivable. And it could also include dividends and received from foreign companies or any income not chargeable under another schedule or the case. Moving on, we are going to talk about the classification of income. So when computing in an entity's tax liability, what happens is they take the income statement and compute the tax according to the statement. So they follow like a scheduler system where the separate figures of each category will be computed by examining the income statement and allocating expenses and income for each category. So when it comes to income, what happens is income can either be like a profit or a gain for a trade. Like when it comes to a profit, it can be kind of identified as an income, and the gain is capital in nature. So any income in the income statement should basically be identified to either revenue or capital in nature. And also it could be expenditure, where it could be an allowable deduction which will be used in calculating the trading profit. So provided that it's like a revenue and not a capital expenditure and not prohibited by any provision in the tax statute or is specifically disallowed by the tax legislation. So basically expenditure can be discussed under different headings. One could be depreciation, one could be disallowable expenditure, the other one could be allowable expenditure. So as you can see, there is a classification which happens in income to identify how the taxation happens, how much the computed amount is, and also the expenditure is kind of classified in order to understand which is allowable taxation and which is not. So when it comes to depreciation and it is a disallowable expenditure, like depreciation and things like disallowable expenditure or allowable expenditure will all be included in here. Okay, so now let me kind of explain to you what depreciation is, what is this disallowable expenditure, so that you get a better understanding of what it is. So depreciation, what is depreciation? This is something that we always talk about in accounting and finance, obviously. So depreciation is what? This is basically like any deduction which is related to like the capital asset of an asset entity. It could be any type of, it could be land, it could be machinery, it could be anything, right? So therefore it is never allowable when calculating the taxable profit. Like the taxpayers can basically use different types of rates and policies in order to kind of compute the depreciation. And like a standard deduction of all taxpayers is the fair for tax purpose. So this standard deduction is basically referred to as like what? A tax depreciation or like the capital allowance. So the qualifying expenditure for capital allowance could be the buildings, plants, or even machinery. Now, looking at disallowable expenditure. Now, what is disallowable expenditure? These are basically the expenses charged in the income statement and which are not allowed for tax purposes. It could calculate, this could be to calculate taxable profit, like it is required to add this expenditure back to the profit, or expenses which are in capital nature are not usually allowable when computing the trading profit. And these items are basically specifically disallowed. So basically any disbursement or expenses of maintenance of parties or their families or establishments or any sums expended for any other domestic or private purpose distinct from purpose of trade, profession or vocation is considered here. Also, any capital withdrawn from the business is also considered as a disallowable expenditure. Now, when you look at even when it thinks something like capital employed in improvement of premises, all these will also, now any type of that expenditure will also be considered as a disallowable expenditure. Now, added to that, if you look at any sum which is recoverable under an insurance, this will basically also be considered as disallowable expenditure. Now, also when it comes to any expenditure on entertaining customers or like any annuity or other annual payment related to disallowable expenditure, it will also be considered as this. Also, any annuity or the annual payment or donation to political parties, all these are disallowable expenditures. Or it could also be at last like things like expenses that related to earlier year and arose in that earlier year. All this will be disallowable expenditure. So the thing is, when you what you would have understood from the listing down so many disallowable expenditure, as you can see, these are things you need to understand when it comes to disallowable expenditure. It's like there is a amount, certain type of expenditure, which will be one thing that you need to kind of understand here is that when it comes to expenditure, there are things that are allowed to reduce the tax amount. The tax income. So that after reducing that, the taxation can be calculated for that whatever is remaining. So those are the allowable expenditure. So when it comes to disallowable expenditure, so anything that is not allowed is obviously disallowable. But anyway, there are certain type of expenditures that are also listed and kind of mentioned that these things are anyway disallowable, so that it's easy for any person who does the income taxation can kind of understand that these particular, if there is some kind of expenditure related to it, that they could make sure they would know that these particular expenditure cannot be reduced. So therefore the taxation amount will not, taxation income, actually the income that is used for taxation purpose would be the amount that is there, and it cannot be reduced using all these type of expenditure. So I just hope you understood all what I meant. So now we'll move on to allowable expenditure. So basically when it's an expense in the income statement, which is allowed to be deducted to calculate taxable income, as I told you, it is all considered as allowable expenditure. So according to the country and country taxation system, we need to understand disallowable expenditure and disallowable expenditure will differ. So obviously the taxation base is obviously differing due to these kind of situations as well. So moving on. So as you know, these are the amounts that are, as you can see, the income, how the taxation base is calculated. Hold on, just give me one moment. So sorry about that. I kind of, yeah. Sorry about that. I just yes, I just kind of put on some. Give me one moment. I'm sorry about this. Where were we? So yes. So we were talking about the classification of the income, and then the how the corporate we were talking about how the corporate tax base is um, calculated, used, where income and expenditure that is to be included to calculate the taxable amount was calculated. So I said expenditure, there are three types which will be calculated to try us understand which expenditure will be included and which will not be included, or which will be used to deduct the taxable income, or which cannot be used to deduct the taxable income. So we spoke about depreciation, then about the disallowable expenditure. So I said these expenditures can we, even though we use it in the income statement, can we use it to reduce the profit amount? No, we cannot. Profit as in the income, the profit amount. So when it comes to allowable expenditure, these are the ones which we can use in order to reduce the expense as well. So after that, now we are going to talk about rollover relief. So in like when we talk about many countries there is when an entity sells an asset, it gives rise to what? Something called capital gain. So, which is kind of included in the entity's corporate income taxation, because capital gain being means that the person who buys it gains something extra out of by that particular asset or that particular land or machinery. So in some countries, when an asset is replaced by another business asset, possible to defer the charge of income until the replacement asset is sold. So there are different, when we are calculating according to the taxation method in each country, there are differences that happen. So like also like we need to understand certain, when it comes to certain countries, when you're selling an asset, how you use that particular sold taxation capital gain, or how much time you have, or can we tax that particular amount, and all that will differ according to the rule. So when it comes to so a relief from capital gains tax is sometimes known as rollover relief. Okay, now we are actually talking about this rollover relief. So what is it? It is basically relief that a person gets from the capital gain for certain type of period because of the taxation base of that particular country. So it allows a deferral of a payment of the corporate income tax on the gain till a later date. So you are supposed to pay it later, not now. So this happens in order to ensure that more new companies coming and invest in a country. These type of methods are used by the countries in order to attract investors. So basically, so when it providing a cash flow advantage and allowing the corporate income tax to be paid in a depreciated currency at a later date is all used, and a new few countries the rollover release is available to be applied for intangible assets. So now we need to look at the treatment of loss. So we've all calculating and trying to figure out things based on the thinking that the organization will have a profit, obviously, and that there is a percentage that the organization need to pay. However, obviously, we know that there are situations where there is some kind of trading, there are losses for organization. That could be something like that. So now we are going to talk about how these losses are included. So first we need to understand that there are two types of main losses in a business. One is the trading loss, then the other is the capital loss. So when it comes to trading loss, these are basically calculated in the same way as a trading profit. So if the trading loss occurs, the company cannot claim tax refunds in that period, and it can basically be mitigated to set it off against profit during other periods, or even to transfer to another group entity, and it may choose to set off a loss against future profit and could have a limited time frame to carry forward a loss, or the UK has no limit to time when a loss can be recovered as well. So this is about the trading loss, where the company cannot claim tax refunds to that particular period. So it can mitigate to set it off against the profit during the other period or anything of that sort. That is a trading loss. So there are the main methods used to relieve losses. There are three main methods. One is to carry forward the trading loss to set off the loss amount against future trading income earned from the same trading amounts, or set off the loss amount against the other income and chargeable gains in the same accounting period, or it could be set off the lost amount against the other income and chargeable gains in one or more preceding accounting period. It could be set off against something future, set off against something preceding, and also set off against some other income which is or the chargeable gains in that same accounting period. Now, I'm going to talk about capital losses. So we were talking about what? We were talking about trading losses. Now I will be talking about capital losses. So basically, capital losses are what? They are calculated similarly to capital gains that we need to understand. So capital losses are sometimes allowed to be deducted from the trading income, but when it comes to most countries, they prefer to keep this separate from the trading activities. Like the most countries set off capital loss against chargeable gains of the same accounting period, or any balance will be set off against the first available future or chargeable gains. So, example, in the UK, capital losses can be carried forward without limits to set off against future period profit, but they cannot be set off against any other income. Okay, so as you can see, we were talking about two types of losses. One is trading loss, then the capital loss. Now we are going to talk about cessation of the business. So if a company makes a loss in its last 12-month period of operation, there is kind of like a limit of relief, and basically this cannot be carried forward according to the rules. So like as a solution, what they do is the country have like special provision for this case. Like in example, there is something called a terminal loss in UK, where the losses can be kind of carried forward for like a period of 3 years, like to be set off against the total profit. Okay, so now we will move forward toward principles of relief for foreign taxes. Now when countries are kind of involved in international trade, like there is certain kind of possibility of being taxed in that particular country of business and the country which the goods are traded as well. So to avoid double taxation and to improve international trade, there are certain reliefs that are provided to these kind of entities. Okay, so double taxation treaties provide relief through different methods. One is there's something that where exemptions are provided. Then there are like things such as trade credit. Then there is something called deduction as well. So first we will be talking about the exemption. What is exemption? When there are two parties which are involved in like an agreement which determines the category of income, which are basically like partially exempted from tax in one country or the other, is called exemption. So when there are two, countries in which the organization does its trading, what happens is if that country, that company is being exempted partly or completely in one country, then the relief that is called here is called exemption. So now let's move on to the next type of next category, which is the tax credit. Now, what is tax credit? This is basically like a agreement which allows the tax paid in one country to be used as tax credit in the other country, right? So when you pay a particular tax in one country, that is being used as a tax relief, and this will be kind of deducting foreign tax suffered from tax due to the country of residence. So relief will be basically here what happens is the relief will be given under double tax agreement, and if there is no such agreement, it will be given unilaterally, and if the foreign country tax rate is higher than the country of residence rate, then the relief is kind of limited to the tax due using the lower rate. So that is tax credit, where the tax which is paid in one country can be used to be deducted in the other country. It is a little different from exemption, because in one country there is an exemption, right? So then, you don't have to include anything there. But here what happens is, if you pay one, you just show that you paid that particular tax amount in that other country, so that there could be a tax credit. And now we are going to talk about the third method, which is the deduction method. So it is always better to claim relief so that the foreign tax suffered is deducted from the tax due in the country of residence. So deduction is basically, it's like tax credit, obviously, in a different way, where the organization already says, okay, right, we are being taxed these things in the foreign country, therefore please deduct these amounts from our taxation in the country of residence. So where the exporter or the company which operates in the other country kind of tells, what is being paid to the other as tax in the other country, which will be considered in the home country as well and deducted from the taxable income. Okay, now we will be talking about the concept of tax consolidation. So this is basically a concept which is like a whole group is recognized for tax purposes, so that the companies within that group can transfer losses between themselves, or if like one country in the group makes losses while the other make profit, what happens is the loss which makes the company can transfer that loss to the other countries under the specific condition, and if the loss is not kind of transferred, what happens is it can be carried forward for the different, the other years, the years coming in future, before it can be offset on future profit. So by transferring the loss to another company within the group can reduce the total tax bill, as they can set off a particular year's loss against that particular year's profit. So capital losses and tax group, different rules apply to tax group for capital gains, and UK requirements for capital gain tax for group are different from trading income tax for group. So like the capital losses are also different from trading and non-trading losses, and capital losses cannot be transferred from one company to another. So now we were talking about, they are all about tax base and how we can calculate the taxable amount. So we are just trying to see So there is this particular, okay, right. What I would do is I will move instead of doing like a sum, what I feel is instead of doing a sum, because it's not necessary exactly in the calculation is basically not necessary when it comes to the module. I will just kind of skip it and then we'll move forward towards the interaction of the corporate tax system with the personal tax system. So, dividends. Basically, dividends are generally not a deductible expense from income when calculating taxable profit. Now, this is because why? Dividend received by the shareholders has already been taxed directly from the shareholder, which could lead to taxable double taxation, and also the economic effect of a corporate tax depends on the system of the income tax used as well. So there are four main systems which are used to deal with interaction. One is called the classical system, the other one is called imputational system, then it would be the split rate system. Then we will be talking about indirect and direct taxes as well. So, yeah, we'll just kind of do some, yeah, try and have a basic understanding of this particular system. So first, we are going to talk about classical system. So now, what is this classical system? The shareholders are basically treated as an independent party to the company, and the income tax does not differentiate between a company's retained earnings and it is distributed earnings. Like according to this system, the company is liable for corporate tax and all of its taxable incomes and gains, whether they are distributed or it is not. Like when the shareholders are kind of treated as an independent party, then it doesn't, there is no, it doesn't kind of, there is no differentiation between a company's retained earning and its distributed earnings. So company is liable for the corporate tax, and they are whether it is distributed or whether it's not. So under the classical system, that is how the taxation happens, because if even if there is sort of like a retained earning, the corporate tax is liable. So the organization needs to pay for this particular amount of retained earning. Moving on, we are going to talk about imputation system. So like all a part of the income tax on distribution is basically assigned to the shareholder as a tax credit. So this kind of helps to eliminate the double taxation on dividends, or under the full imputational system, all the corporate tax is kind of passed to the shareholder as a tax credit. So full imputation system is kind of economically neutral between the debt and the finance equity, and also it could be partial imputational systems. Now, only a part of the corporate tax will be passed to shareholders as a tax credit. We need to understand here. So, and this is how the partial imputational system happens. Now, there's another method called split rate system. So this system basically differentiates between distributed profit, retained profit, and charges a low corporate income tax for distributed profit, because this is in order to avoid double taxation on the dividend. Because say, if the same amount is being taxed from the organization, and thereafter individuals also have to pay this particular amount for taxation, then obviously there is double taxation. Therefore, split rate systems are used in order to ensure that there is no double taxation. So now we will be moving on towards direct and indirect taxation. So yeah, so what I would do is I will be talking about direct and indirect taxation a little bit. later. So we've been talking about individual taxation and corporate taxation base today. We'll kind of try to understand what these things are. So if I do a small recap of what we've actually done in this particular main um, uh, topic. We talked about functions and purposes of the taxation. We spoke about economic purpose and then the social purpose, and we also talk about different environmental factors, how it affects taxation. Then we moved on to the type of taxation, where we talked about capital and revenue taxation, where I spoke about capital gains tax and the inheritance tax. And then we moved on towards things such as different transfer of value, how the transfer of value can be calculated, what are chargeable property, chargeable people, and what is chargeable transfer. And moving on, we kind of spoke tax revenue, which are tax on income. There were 4 types actually. One is called income tax, which we spoke today, where which is for individuals and partnerships, we said, and corporate taxation is for chargeable profits of company, and in IC, or the national insurance contribution, which is for partners, employees, and employees, where the system of taxation is paid by the employee based on the weekly earnings and the money he is gathered to use provide social security. Then there is something called value-added tax or VAT, which is on the final consumer, where the consumption tax paid by the consumer other than the normal price of the good is considered. Then we spoke about different types of principles of income tax and the basis of income tax. So this we spoke about today, who is liable, and then we spoke about who is a resident and ordinary and domicile person. And I said, this is how the income tax is kind of calculated, and how we try to identify property income, dividend income, and even things like savings income. And then we moved on to try to understand what is tax exempt income. Then different types of corporate tax based as well. So we talked about scheduler system, classification of income and expenses, and also things like how the losses are traded, and relief of foreign taxes are being used, and credit or deductions are being used. Okay, so these are all considered, and we spoke about different types of taxation system, which is classical, imputational, and split rate system, right? So I said there is indirect and direct taxation, which I will be covering using our last lesson next week. We will obviously be finishing off that section, obviously. And next week would be our last section for the module. So I just hope you went through everything well, and that this knowledge will kind of help you out to do your assessment really well. And I hope you have a good week, and see you everyone. See you next week. Goodbye.